Hello class, this is Delmario Goodrich, and today we'll be discussing capital budgeting as it refers to the New Heritage Doll Company. And as you see right now, this is a financial snapshot. My ending APV was 610.60, so I will be discussing how I got that number. So basically, if you look at the revenue, operating income, and net income, then, well, first off, this is 2009. So the revenue for 2009 was 245.75. Operating income was 22.60, and then the net income was 13.56. And then in the current year, you can see that all of those have increased significantly, with revenues being 336.92 and the operating income being 37.70 and the net income ending at 22.62. So basically, before I go into how I got these numbers, it's very important to look at the project updates. So with the Dollhouses with Miniature Dolls is the company that I invested in. So this project launched successfully, but with somewhat lower margins than expected, attributable to higher production and marketing costs. Also, the coupon promotion and frequent shopper campaign. The campaign was effective, but fell somewhat short of the retail division's revenue targets. We also have the Toddlers Music CD series, which is the initial revenues from toddler CDs were twice as large as anticipated, and the last investment was Young Authors Book Series. Best of Girls books were an immediate success with the targeted demographic. Both revenue and profit levels exceeded expectations. Now, furthering what I said about the project updates and what I invested in, if we click on the project updates tab, just let it load a little bit, then we will be able to see the exact estimate, the exact investments that I've made over the last 5 years. So in 2009, I invested in four different things. In 2010, I only invested in one, the Dolls of the World Initiative. In 2011, I went back to doing 4. 2012, I added a few more, and with a total of 6 in 2012. 2013, I decided to go back to just doing the regular 4. Now that we have looked at the previous investments over the last 5 years, we can now look at the project details, which will just explain more so why I invested in the companies that I did and the companies that I profited off of based off of my current investment. Okay, now looking into the project details for the dollhouses with miniature dolls under the division of production, you can see that, well, first off, we get the project discount rate of 7.85%. But if you click this, then it'll pop up and you will see that the corporate discount rate is 78.5%, which is in between, pretty much in between low risk and medium risk. So I'm not taking too much of a risk and I'm not taking too small of a risk. But if I were to go in and just lower this to, let's say, 5%, let's just do 5%, then before I even click enter, let's see what my NPV rate was with the 7.85%. With 7.85%, my NPV would be 12.76, with the payback period of 7.75 and the lifetime projected cost of 4.73, so basically 5 years. So now that I go back to the discount rate of 5%, lowering it just under 3%, if I click the enter button, then my NPV. Yeah, so when we change the discount rate to 5%, you can see that the NPV has went from 12.73 to 40, and the payback period 7 years, and lifetime projected cost is still the same. But now if you scroll down to the cash flow statement, you can see that we're still doing good. We're still in the positive because the total cash flows is still increasing pretty significantly, actually. It's by about 0.2 to 0.3 every period. And now if we scroll down to the ending cash balance, we're also still in the positive because it's increasing from 0.2 to 0.31 to 0.35 and so on, and we finish off with 0.76. Now if we were to scroll up, and I'll just go back and change this back to the 7.85 as it originally was. Okay, now we were to pick another investment. Let's do Match My Dog clothing line. Now we do Match My Dog clothing line. You can see. Oh, sorry about that. Match My Dog clothing line with the 7. We're still in division of production. The projected discount rate is 7.85%, and it's still with the same chart. It's still in between low risk and medium risk. So we're still doing pretty good on the discount rate. Now we were to, without even changing anything, if we go down and look at cash flow statement, we can see that we are still doing significantly well as we start off with 1.57 and it increases to 2.77. And if we continue to scroll down to the ending cash balance, we're still in the positive as it goes from 0.36 with an ending balance of 0.63. And just like the previous one, we'll go ahead and change the discount rate to 5. Well, instead of doing 5, let's actually do something lower. Let's do 3.75 and see what we get. Okay, so at 3.75, we're still getting a pretty realistic NVP of 48, which is still a good number, actually. It's positive. And if we go down to the cash flow statement, yeah, see, we're still doing good because we have 1.57 and it's ending in 2.77. So this is pretty much the same as the previous one of the 7.85% discount. Oh, sorry about that. I never clicked enter to get the new results. Oh, maybe those were the new results. Sorry about that. Okay, so lastly, we'll just finish off with one more. I'll do replace assembly equipment Sacramento. Okay, so you see the default discount rate just went back to 7.85%. NPV is very, very low. It's only 0.06. But as we now know that every time we decrease the discount rate, we will increase the NPV. So I'm just going to go ahead and decrease the discount rate to 5%. And we will see the NPV increase. There it is. NPV just increased by 0.02. And this is a very small project. It's not going to cost so much. The lifetime projected cost is only 0.08 with a payback period of just 3 years. Let's go down to cash flows and see if it was a profitable investment. Now looking at the cash flows, this would not be a profitable investment just because it started off as 0.04 and over time it has gone down to 0, and the ending balance has started at 0 and ended at 0. So that's actually not one of the good examples that I want to show. Okay, so let's look at the Tyler-Dahl accessory line again. So NPV is 6.82, and that's with 7.85 discount rate. So again, by decreasing the discount rate a little under 3%, we will see the NPV of 6.82 increase. See, the NPV rate has just went from 6.82 to 19.76. When we go down to the cash flow statement, it should be going above in profits. Yeah, it starts at 0.93 and it ends at 1.49 with the ending cash balance of starting at 0.40 and ending at 0.64. So now after showing a couple of examples, we can just go back to the dashboard and see the pie chart of how the investments that I've chosen over the past 5 years have been pretty good investments. As you see, the red is our production. Production is good. It's doing good. The licensing, we're not really too worried about that. That should be one of the smallest factors on your pie chart. But as far as retail is at 235, so that is pretty good. We're doing good in retail right now. And the company APV is 640. And then you just want to look back at the revenues again and just make sure what you want to see right here is that revenues is constantly increasing. So by looking at the numbers, you can tell that each year we're only doing better and better as far as revenues and income. You see an increase for each year. So with that being said, I want to thank you all for listening, and hopefully you all learned a little bit from my simulation. Thank you.